At the start of this year, it really felt like the housing market was turning a corner. The forecast? A modest but steady recovery. But then a global crisis hit, and boom, all bets are off. So, what on earth happened? We're about to connect the dots and show you exactly how the entire outlook changed, almost overnight. It seems like two totally different worlds, right? The price you pay at the pump and the price of a house. But what if I told you they are now directly linked by this powerful economic chain reaction? Let's follow that chain and see exactly where it leads. Okay, so to really get the scale of this shift, we've got to rewind to how things looked at the beginning of the year. The mood among economists was, let's say, cautiously optimistic. Nobody was predicting a crazy boom, but the general feeling was that we were finally heading towards a decent recovery. And here's the specific number they were looking at. Zillow, which is a huge voice in the industry, was predicting a 4.3% increase in existing home sales. That translates to about 4.26 million homes. Now, that's not a massive boom, but it was seen as a really clear sign that the market had finally turned a corner. That was our baseline. And then came the wrinkle. A major conflict erupted in the Middle East. All of a sudden, oil prices started to soar, and that economic fallout began rippling across the globe. This was the one thing that no standard economic model had accounted for, and believe me, it sent forecasters scrambling. So, Zillow's new projections. These weren't just minor tweaks, nope. They were a direct response to this new global reality. The entire foundation of that original forecast was shaken by something that, just weeks before, wasn't even on the radar. The whole outlook for the year just had to be completely rewritten. So how exactly does a conflict thousands of miles away hit the U.S. housing market? Well, it happens through two big economic shocks. You can think of them as the first two dominoes to fall. And they affect the two things that matter most to home buyers, the cost of borrowing money and job security. Here's how that whole chain reaction plays out. First, high energy prices spark fears of inflation. And to fight inflation, the typical response is to raise interest rates, which, you guessed it, pushes mortgage rates higher. At the very same time, when we're all spending more on gas, we spend less on everything else. That slowdown can cause businesses to cut back, which can, unfortunately, lead to higher unemployment. And look, this isn't just some theory. It's already happening. Since February, mortgage rates have jumped by about 50 basis points. That's half a percentage point. Now, I know that doesn't sound like a lot, but that tiny change has a huge impact on how much house a buyer can actually afford. In fact, Zillow's chief economist, Misha Fisher, put it pretty starkly. He said that 0.5% jump basically wiped out about 1/3 of the affordability gains that buyers had just started to see when rates dipped earlier in the year. That is a massive setback in a really short amount of time. So with all this new uncertainty, Zillow basically threw out their old single-point forecast. Instead, they've come up with 4 totally distinct scenarios. And the one thing that separates these possible futures is a pretty simple question. How long are these twin shocks, higher mortgage rates and higher unemployment, actually going to last? This table lays it all out, and it's pretty fascinating. In their best-case scenario, right, if these shocks fade by May, we'd still get nearly 3.5% growth. Not bad. But look what happens if they last until July. Growth drops to 2.3%. And if they persist all the way to the end of August, it's a tiny 1.2%. And here's the kicker. If these conditions stick around all year, we're not talking about slow growth anymore. We're looking at an actual decline in home sales. This chart really puts the change into perspective. On the left, you see that optimistic original forecast of over 4% growth. Then, in the middle, you've got the new best-case scenario, which is already a lot lower. And then, all the way on the right, is the worst case, a negative number. The range of what could happen has just exploded. So, after all these models and scenarios and numbers, what's the bottom line? What does this actually mean for you, for anyone out there trying to buy or sell a house right now? Well, the biggest takeaway is this. Uncertainty is the new normal. That predictable, slow recovery that everyone was banking on, it's pretty much off the table. For the foreseeable future, the health of the entire U.S. housing market is directly tied to global conflicts and energy prices. Stability has been replaced by volatility. Which leaves us with one last question for you. In a market where the old rules just don't seem to apply anymore, what's the single most important factor you should be watching? Is it the daily mortgage rate, the price of gas at your local station, or something else entirely? For anyone even thinking about buying or selling a home, Figuring that out just might be the most important thing you do all year.